Hi, Professor Barati. Just want to go over this week's financial statement analysis chapter and give you some tips on some financial analyses that I think will also help you with your case study on researching the financial reports on a company. So this is Morningstar, and I've sent you the link in this week's discussion on how to access it. And you don't have to register or sign in. You can just use it the way I'm using it here. So what I've done is what I'd like to do is research Daimler AG. Now Daimler AG is Daimler Automotive. It's a German company that we all know. They make Mercedes-Benz. And so what I like to do is research. What you see here is a quote for the stock. Right now the stock is trading at $16.02. And if you go across, you'll see a menu that you can access a lot of information. And right now, Daimler is giving us a forward dividend yield of 7%, which is very good. The price to sales is 0.36, which is 36 cents. So, and the price earnings is $6.15, the PE ratio, which is very good. It's low. But keep in mind, the auto industry tends to have a lower PE ratio, and the price to book is 0.93. So these are very value-oriented metrics. And as you can see, Morningstar basically gives us an investment style, a large company value stock. Meaning you're not really going to pay a premium for this company. But what I want you to do is click on key ratios. And here you'll see that Daimler's revenue growth over a 3-year average has been 8.16. Its net income growth has been 14.77. TTM is trailing 12 months, so operating margin as a percent of sales is 7.27. Right now, as of 2018, Daimler has a negative $13 billion free cash flow for the year. Return on assets trailing 12 month as a percent is 3.69%. Return on equity is 15.54. Its net margin or net profit divided by sales is 5.77, and its debt to equity is 1.08. So for every dollar of equity, there's $1.08 of debt. And what I do is click on full key ratio data, and this gives you a nice chart. What we're doing here is essentially what's described in the text as trend analysis. We're looking at the trend for Daimler Chrysler. We're seeing that Daimler over time has been increasing its revenue. A 3-year rate is about 7%. The gross margin has been coming down a bit, which is a cautionary sign. And operating income has been struggling to accelerate. Operating profit margin as well, it seems to be coming down a bit, which again, a cautionary sign. But earnings per share has been increasing. So one question you want to look at as an investor is how is earnings per share going up when gross margin and operating margin have been declining. Essentially, Daimler is basically probably selling more units, more cars at lower prices. Daimler has just introduced a dividend, which is new. The payout ratio basically means that 41% of Daimler's profits are going towards paying out dividends. So you're going to learn about retention rate in this class. The retention rate is 1 minus the payout ratio of 41%. So that's the payout, the retention rate. Free cash flow. Basically, Daimler has negative free cash flow because it is investing heavily in CapEx. It is here where you see some of the key margins, like net margin, the asset turnover, which is an important ratio. Asset turnover is sales divided by total assets. So for every dollar in assets that Daimler has, they generate 64 cents in sales. Return on assets is 3.69. Again, return on assets is going to be net income divided by total assets. Financial leverage is also a debt ratio. Return on equity, 15.54%. It's been coming down. So you want to look at trends and see how this is doing. Another key area is growth. You can see over 5-year average revenues at 7.53. Year over year was close to the 5-year average. Right now they're off to a slow start in the quarter. Operating income for the quarter has declined 23%. Again, this is not, in the world of investing, these numbers are not draconian. We don't know if these quarters where these companies are seasonal or not. But again, year over year, 7.54 is below 3 and 5-year averages. Net income and earnings per share gives you the growth rate. Cash flow, key ratios are right here. That can help you. Efficiency ratios, days sales outstanding. Essentially, Daimler basically gets its receivables every 95 days for the trailing 12 months. Inventory, days in inventory. Receivables turnover, 3.85. Fairly low for a company. Inventory turnover. They turn over their inventory 4.72 times a year. Some companies and industries do 10, 11 times a year. You can also export this into Excel for a spreadsheet, which will help you. Another area you can do is go right into the financials themselves. And it gives you revenue for the past 3 years, year to date, trailing 12 month, 5-year average, 5-year growth rate. So you want to, in finance, you want to measure, you want to see what the company's metrics are doing over time, not just year to year, but year to date. Look at the 5-year average, look at the 5-year growth rate, and so on. Click on all financial data, and you basically can get the income statement right here. You can get the balance sheet over several years. You can see that receivables are indeed growing, which is a turnover, which explains the lower turnover. You see inventory as well as growing, which explains the lower turnover. Something's going on there. The financials aren't going to tell us, but they do. By measuring, you're coming up with questions to ask. Another area is intangible assets are growing. Why are intangible assets growing? Is Daimler doing acquisitions? And if so, are they generating a return on that investment that increases shareholder wealth? Another thing that I like to do is take the balance sheet and do a common size balance sheet. I can turn this balance sheet not only into dollars, but percents. And what you want to look at is significant changes as a percent of your assets. So right now, Daimler's receivables, I had issues with that, but it looks like as a percent of total assets, their receivables are running at 17%. Inventories at around 10. So there's a lot of consistency there. What you want to look for is any major anomalies going on. And then that might be stated in the annual report. You want to go to the annual report and read and see if you can get some answers through that. Liabilities are holding steady at 6%. Accounts payable holding steady at close to 5%. Long-term debt has increased over time, so the company is becoming a little more leveraged. You're going to learn by using the DuPont model how the company is generating its return on equity. It can either do it through net income, it can either do it by asset turnover, by being more efficient and therefore earning a return on assets, or it could do it by issuing more debt. Debt, because interest is tax deductible, has a lower weighted average cost of capital. Therefore, more debt is actually cheaper than equity as far as generating returns on that money you use to invest in. So therefore, a lot of companies in the low interest rate environment that we've had for the last 8 years have been increasing long-term debt. So I like to do that. I like to do the same for the income statement. Look at a percent. See if there's any change. Notice the cost of revenue is going up, which explains why gross profit as a percent of sales is going down. And then the cash flow statement. How is Daimler generating cash? Looks like they're going through a change in working capital is generating a negative cash from operations. So why is there a change in working capital going on there? Working capital is current assets minus current liabilities. So their current assets minus liabilities. So something's going on with their working capital. Inventory as well. And then they have this other working capital. So as you can see, net investments from operations is negative. Net investments from investing in capital expenditures is also negative. So in order to generate enough cash to pay its dividends, they have to finance. And the finance is where they're making up the difference. Other financing activities, okay? Seeing other is not necessarily a good thing, so that has to be explained in the 10K or annual reports. So it's interesting things going on that raise a lot of questions. Valuation, PE is 6.2 versus industry average. Price to book is lower than industry average, price to sales, and so on. So obviously, Daimler's stock at $16 might look like a bargain, but there's a reason why. Notice the stock went from a high and now is trading at a low. Now, the key is, can they turn things around on their ratios and metrics to get that stock price up? Another important website that I recommend, it's called Guru Value, and it is a finance. This is a website called Guru Focus or Guru Value, and it is, I'm using Ford, and the nice thing about this is it gives you Ford's ratios compared to industry, operating margin compared to industry, and it'll give you the ratio for the industry is 3.83, their operating margin is 3.83. Net margin for Ford is 4.27. The industry is 3.84. Return on equity for Ford is 19.56. The industry is 8.97. So they're beating industry. That's why you have a nice big green there. So PE ratio is 5.59 versus the industry of 15.55. And you can see a nice litany of ratios here compared to industry. Another thing I like to do is use the discount cash flow analysis. What they do is they take their earnings per share and they say over the next 10 years with a rate of 5%, with a terminal growth rate of 4%, they use a discount rate of 12%. They're saying right now, based on a discount rate of 5% and terminal rate of 4%, Ford's value is at $18.09. They value it. Right now, Ford is trading at $9.45. Reverse discount cash flow is a neat analysis on this website that basically says what is the price based on the discounted cash flows, what are investors basically valuing this business. Basically, based on the price of Ford right now, they're saying that investors are expecting a negative 5.69% growth rate. So even if Ford grows at 0%, doesn't grow at all, the fair value of this company is $13.25. It's selling at $9.45. So then basically investors are saying that this company is they're basing it on negative growth. So if Ford can get growth back, this stock might be undervalued as a company. Again, I'm taking more of an investor approach. You don't need to take that approach. You need to just basically analyze the financial statements. Again, you want to look at trends and you want to ask questions. Why? Why are things fluctuating the way they are? So this is just some tips on the financial statement analysis and how to approach it. Again, there's no right or wrong here. It's an approach that we all will eventually cultivate, and do a lot of reading and go into a lot of websites and just be curious and show an interest in it, and you'll start seeing that this is an amazing world. Finance is an amazing world. Thanks for watching. I hope this helps.